It is Monday, April 25th. I am your host, The Cowboy. This is Elliott Wave Cafe and another edition of the Chart of the Day. Let's get started. So here we are on a day where Elon Musk buys Twitter. The stocks open lower. They close very heavy on Friday. They opened overnight. Futures were dragging everything down. You're going down all the way to about lunchtime, and then you're getting a little bit of a rally here to close the market. So pretty interesting turnaround today. We'll see if this is what leads maybe to a stronger rally, but I'm not going to assign this to the fact that Elon Musk just bought Twitter. That's probably besides the point. However, VIX was heavily spiking here this morning, and you could see that that was something that could be faded. I was talking in the program to the guys, and I said into the morning update, we were talking about, kind of how heavy the sentiment is, where we are in Bitcoin, trying to break that, 38.5. Then Nasdaq was pushing lower, VIX was pushing higher, and everything kind of felt too heavy too early. And in one of the morning notes, we talked about an upcoming rally there. So interesting, definitely setup. We actually longed the S&P 500. And we just kind of got out here right before the end of the day. So anyway, just a quick story on kind of what happened today. But we're going to take a look today at about Nasdaq 100. So this is a market that's obviously widely followed. It's one of the major indexes out there. It's where you have a lot of the growth stocks. And it's been obviously, in a pretty strong uptrend here for, the past, this 30 years. So, you've had the crash, the dot-com crash here, and then, you went higher. I think this is a second wave, and then you go up in a 1, 2, 3, 4, and 5 for the wave one. You have a second wave here at the pandemic low to this flat, and then I think you're beginning the next advanced higher in a 1, 2, 3, 4, and 5 for a larger third, fourth, and fifth. So this is kind of what I see in the Nasdaq. So this is the bigger, larger channel, right? That will take years and decades to kind of move forward and continue to grow. Remember, stocks follow earnings. Earnings continue to grow. Stocks move in and out of favor, but they continue to make money to develop. The price should follow the earnings. So you have little blips every once in a while, right? The market gets very, very frothy. Then you have some bigger sell-offs. I don't think we're anywhere near, such a big, inflated market that we've had back in 1999. This is more of I think, even though, there's a lot of stuff that's overvalued there, I think it's more of a normal kind of growth trajectory in here. I mean, this was a rocket ship to the moon, and it was kind of quickly corrected. This one, it's more of I would say just a kind of a regular standard bull market that continues to grow. You can see the smaller channel in here inside the larger channel, and I'll show you a little bit of a bearish counter as well, but I'm going to go with this as my primary. I think we are in some kind of a second wave here, and this should lead to further advance. You might think it's a 4. I don't have a proper subdivision to consider this a fourth wave, so my thought process goes towards the second, but remains to be seen. We'll take a look at the smaller time frame, but this is kind of what I'm looking in terms of a larger kind of growth trajectory of this market. And this, especially lately here, these markets are very, very correlated with the Bitcoin market and crypto market. So that's why we're obviously paying attention on kind of what's going on in here. I think it's been this a bunch of the sectors in here have been beaten down a lot, and they're trying to recover, especially those ARK names. So here is next. We're looking at a little bit of a shorter time frame. I think this is a daily. So we have this decline, which is a tricky decline. It could be impulsive, it could be corrective. It's not very, very clear. You can do a leading diagonal out of this decline here in a 1, 2, 3, 4, and 5 for a wave A. Then you can do an ABC for a B, and you can do a C wave decline. So this would be that ABC for a larger second wave. It could become a much larger sell-off if it becomes impulsive. But I still have doubts about it. I think it's a tricky one. There is no secret juice in here. It's not as cut and dry. So anyway, shorter term, I am expecting a little bit of a rally. out of here from these lows. I don't think it's going to completely fall apart. Even if it makes new low, I think we're still going to get a rally. That's kind of what the sentiment tells me in here. And I'll take a look at some breadth indicator and you'll see what's going on in there and kind of why I have this thought process. So I think we're going to get a little bit of a rally. Then we'll see how sharp it's going to be, if it's going to go all the way back here towards A, if it's going to be part of a triangle. I'm not sure. But, I don't think we're ready to massively break to the downside. We have some seasonality that I want to take a look at. This market could be, kind of drag sideways to correct for a while before maybe in the fall, maybe in the winter, at the end of the year, you might get a sharp leg lower. But let's see where we are. And this is very, very, guys, this is very, very related to what's going on in the with the Fed and how much tightening they're going to do and how much liquidity they're going to take off from the market, right? That is where the market participants are looking. That's where the bond market is looking. So it's all interconnected. And that's why, becoming proficient at reading these markets, in terms of a macro perspective and looking at what's going on with yields, what's going on with the yield curve, what's happening with the rates, what's happening across the globe, what the message is, combined with that with the wave counts, it can help you and protect you at the same time. So here is the wave count that I think I'm quite comfortable with, but remains to be seen. I mean, could you consider that this is a second wave in here? Oh boy, that would be an interesting one, because that would mean, you're having a big rally coming up. And the markets are pretty bearish. I don't know if anybody's prepared here for this market to make new all-time highs. Imagine if that happens, right? That would be something to write home about and to tell your grandkids, but it's interesting. So let's jump over and take a look at the next one in here. So I'm having the bearish scenario where I'm counting this move from this lows to the highs as a strong impulsive move, a terminating move in 5 waves. 1, 2, 3, 4, and 5 for the third, flat in 4, and then up in 5, and then you're beginning a much larger decline. I don't know what that would be. It is a second wave. It is a fourth wave. Whatever this is, it's going to look ugly, because if it's correcting, it's probably going to correct all the way back here to the pandemic lows towards 6,000. And that means that this market is about to get cut in half. Now, this A wave, it's not going to completely happen all of a sudden. You're probably going to get that one second wave, then 3, 4, and 5 for an A, and then you're going to get a B and a C if it's going to be a zigzag, right? But this is the bearish scenario. I'm looking at this wave 5 versus wave 1 at equality, right? That's where it kind of stopped. It's a totally fine scenario. I have no arguments, against it much, other than what's going on, at the Federal Reserve level and what's going to happen with the monetary policy going forward, how much this economy will decline and how fast they're going to go back to loosening, their tightening stance and go back to an easier policy, because if that happens, the markets will probably rally to the upside. So it is a scenario we're following. I'm fully prepared if this thing starts to pan out. Nobody knows. Nobody can tell you exactly what's going to happen. We're putting scenarios and we're adapting to what's happening in the market on a pretty much day by day, if not on a week by week basis, by constantly monitoring the signals, looking at the breadth indicators, looking at the counts, looking at the message from the Fed, looking at sentiment. All these things create an overall picture in how you want to be positioned, if you want to take risk, if you don't want to take risk, if you're, let's say, focus on smaller time frames for right now, rather than a big, larger uptrend. So it's all a matter of digesting that. So I wanted to kind of quickly show you what's going on the breadth here. I'm looking at the percentage of stocks above their 200-day moving average. So I'm looking at the Nasdaq 100, and these are right now at about 30% of the stocks are above their 200, which means that 70% of them are still below 200-day moving average. That's a pretty bearish market, right? That's a pretty, it's a market that's just not participating. It's not strong. It's struggling. You're below the 200-day. That means trouble. So 70% of those stocks are below. But here are the good news. The good news is that the Nasdaq, it's approaching the point to make new lows, but the stocks, below their moving average, right? They're not approaching here new lows in here, right? Or percentage above their 200-day moving average. They're not coming nearly close to these levels. When we had these lows in here, only about 21% were above, which means 80% of the stocks were below the 200-day. So continue to pay attention to this. I think this breadth indicator is kind of telling you something. You know, if this market makes new lows and this thing starts to push higher, or it's losing its downside momentum, that means that you know, there is an underlying strength into this market that's going to lead you to a much larger rally, right? These things are not really sustained up into these levels, right? Unless you have a really prolonged bear market. This was a sharp decline in here. We had divergences into the breadth indicator. I showed this to you guys on the S&P 500 discussion as well, because the breadth in the Nasdaq was deteriorating as the Nasdaq was making new highs. The percentage of stocks here were continuing to decline, and then I'll show you on the 50 where you actually had the divergence. So this is what I'm watching on you know, on the Nasdaq here, and then going quickly to the 50. Here is what's going on the 50 percentage of stocks above their 50-day moving average, where we're looking at it as you know, they're coming. I mean, this will be more tied, right? Because the 50-day it's much closer to the price. But even here, you know, you're not getting a larger sell-off in here in stocks, and the you know, and the percentage of stocks above their 50-day moving average, it's kind of stable. It's not a problem. I mean, look how high it is versus where the S&P 500 price is versus these lows, right? So look at this thing. I mean, this was like 12%. 85% of stocks were below their 50-day, right? Right now, it's 30%, right? There are above. There's 70% they're below. So, and the price is near these lows. So it's very interesting what's going on. I think we're going to get a recovery in here, guys, and the breadth indicator are kind of starting to tell us that. The other thing I wanted to show you, it is growth versus value. So I'm looking at growth versus value as a ratio because you know, there's a lot of growth names into the Nasdaq 100, right? And I think it's important to kind of study this. People were flying in this correction towards value and towards dividend paying stocks, and you know, something that, let's say, it doesn't move as fast as growth moves. It's more of a safety stock where, you know, you don't get a lot of beta out of those stocks. They're just more low volatility and they pay you dividends, and, you know, you're going to be safer in there. And this is kind of what this shows you. If this ratio goes down, people choose value. If this ratio goes up, people choose growth. What is growth? Let's say Nasdaq stocks and you know, let's say high flyers. So you're looking at this as, and just, I mean, you know, look at this Elliott wave structure. I mean, you got an impulse, and then you have a three-wave setback, right? I mean, you know, I don't have to convince you if you've studied Elliott wave and you know what an impulse is and what a corrective pattern is. This is right here, you know. And if you look at the Bitcoin chart, it looks fairly similar to this. Now, Bitcoin did not make a new low, right? But it's there. It's in terms of its growth trajectory, it's exactly where you are. If you overlay, it's almost exactly growth versus value indicator. Okay, so I'm looking at this as a 5-wave. You're going up here. I don't know if you make a new high, and then you come back in another 5-wave. So to me, this could be a very clean zigzag. You know, that's about, you know, looks pretty good in terms of equality. So what do I expect from this? Well, I expect growth to start pushing higher and outperform value. So maybe it's time to sell those stocks that give you value and get a little bit more growth stocks that don't pay dividends, stocks that are, you know, higher beta and then just moving faster. I don't know how that's going to, you know, tie in with the tiny monetary policy, but maybe there's something we're missing out there. But the charts here are telling you be careful, because this ratio could be turning higher. Now you might want to wait a little bit, maybe until it kind of goes back and passes 165. but it's kind of started to pay attention to this, right? Growth versus value, very important, and I think it's sending us a signal here. The next one that's kind of tied also, to this one and to Nasdaq as well. I'm looking at pure growth versus pure value. So this one was IWF. So this is Russell 1000 growth versus Russell 1000 value, and I'm looking at S&P 500 pure growth versus S&P 500 pure value. This is a similar story, right? It does look like a zigzag in here, right? It's pushing pretty nice. I mean, you have an impulse, you almost have like a correction up, with another impulse in here. So I don't know. I mean, to me, you're coming into some serious support levels in here. I would want to take a chance that growth in here, pure growth, will start to outperform pure value. What's in pure growth? What is in pure value? Here we are, RPG. This is your pure growth in here. You have energy, you have Fortinet, Tesla, Diamondback Energy, Goldman Sachs. These are the top 10 holdings. There's only about 55 in here. And then you have, this is a much larger holding, 499 stocks in here from Apple, Microsoft, Amazon, Tesla, Alphabet, Nvidia. So when these things sells off, right, they take the market with them. These are the big guys in here. So you have Home Depot, Visa, Facebook. So that's kind of what we have in there. Now, here is this one. Check this out. Seasonality in the triple Qs. This is the ETF that follows the Nasdaq 100. Triple Qs, if you want to trade it, right, all day long. You've had a bad period of seasonality historically, right? You are in a, starting from, and these are the trading days of the year. And you begin in January, and here you are, several months in, and this has been a pretty bad period for the Qs in terms of seasonality overall. But just about when those breadth indicators starting to improve that you saw on the charts, this starts to show you in here that the sentiment into that market seasonally starts to get better and better and better until you're getting towards the fall, where you're going to have another sell-off in there, and then you're going to have more rally kind of coming. So it's I agree, it's more of a choppy kind of move in here, right? It kind of bounces, but it's got a positive slope trajectory into this market. So be prepared in terms of seasonality to see maybe some interesting price action in growth, some interesting price action in Nasdaq, some interesting price action on the risk assets, maybe in Bitcoin and cryptos. And, this chart here kind of shows you, what's coming. Now, if I don't have the current year performance, it's pretty bad. It's so bad and so nasty that it's unbelievable, right? So we're way below the performance of this ones in here, minus 1.5. No, we're down like 15% or something, or 20%. I'm not sure. But so there's a lot of wood to chop to the upside. And, it's just another year that's going to add up. That's going to add up to this average, right? But seasonally, we should be turning in here. Now, here are the months of the years on QQQ, and you have January, February, March, and then in the month of April, we're still pretty negative in here, but it's supposed to be a really good month for the Qs. Not really so far. We have about 5 days left, so maybe a massive rally it's coming, and then you got May, June, July, August with decent performance. I mean, anywhere between 50 basis points to 1.5%. Then you got some weakness down into August, September, and then October, November, December, you're starting to kind of rally again. So this is where the seasonality is. You know what I forgot to do, guys? I forgot to tell you to subscribe and like this channel, these videos, these updates. Leave your comments. Let me know what you think. What else you want to see? Thank you for commenting, because I saw some interesting ideas that I'm going to jump on as soon as I have some time. But again, I appreciate you being here. Don't forget to subscribe and like, and I'll see you tomorrow. And hey, visit me in the program if you want to trade with me. Take trades every single day. See what I do, how I talk about the markets, how I think about them. We do morning videos in there. It's a lot of stuff. So come and check us out. The link for that is below the video. I talk to you later. Bye-bye.